All right, thank you, Isha. The next panel will be about the evolution of Web3 payments, building a competitive digital payment stack. With speakers, Stefan Rust from Truflation, Raza Zaidi from Scroll, Garm Lucassen from Glow Dollar, Thomas Mattimore from ABC Labs/Reserve, and our moderator, Maya Cadell.
Sit in the middle.
I'll be in the middle.
Okay, everyone. So we've obviously had loads of exciting talks. We're all here for a specific reason. We know that payments make sense. We finally found something that has hit product market fit in crypto, which is exciting. And stablecoins are already powering over $2 trillion in organic payments annually. And so this conversation is about building the future of building the evolution of Web3 payments. What does a competitive digital payment stack truly look like? So I want to frame this conversation a bit, introduce a new jargon, PayFi, introduced earlier this year by Lily Liu from Solana Foundation. PayFi is the creation of new financial markets around the time value of money. On-chain finance can enable new financial primitives, product experiences that are impossible in Web 2. So that includes the application layer, the compliance layer, currency and custody layers, so whether that's Circle, Tether, ABC Labs, Glow Dollar. And then also the transaction and infra layers, so the likes of Cello, Base, Scroll. So I've hinted at some of our guests, but I want to give them a chance to introduce themselves. Do you want to start?
Sure, thanks. I'm Garm from Glow Dollar. Glow Dollar is a stablecoin much like USDC. It's US issued, US regulated, 100% backed by fiat, mix of cash and US treasuries. The big difference is we are structured as a non-profit, and that allows us to take all of the profits and donate it to charitable causes and basically the crypto ecosystem through grant programs. And yeah, we're live on 7 chains, growing slowly but surely, and excited to be here.
Awesome, I guess I'll go next, right? Hi, I'm Stefan Roos. I'm the founder and CEO of Truflation. We bring real-world prices onto the blockchain. And what do we do with Truflation? We created a flat coin called Nuon. Previously, I was the CEO of Bitcoin.com, where we scaled to about 50 million wallets and about 500,000 merchants, physical merchants that could accept crypto as payments.
Hello everyone, I'm Raza, head of growth at Scroll. Scroll is a layer 2 ZK solution. We're very much like ZK is our bread and butter, where we still believe that ZK can scale infinitely. And yeah, super stoked to talk about stablecoins, payment. I think that we often talk about DeFi having product market fit. Stablecoins maybe seem boring, definitely not to me. And so, and I think that payment is at least for me, the next frontier where I see us at Scroll delivering value for the community.
Stablecoins aren't boring to me either. My name's Thomas Mattimore. I'm the CEO of ABC Labs, which is the protocol development team for the Reserve Protocol. The Reserve Protocol lets anyone permissionlessly launch a index. That could be a money market-like thing, an ETF-like index, etc. So far on our platform, we have the largest ETH LST index. We also have a yield-bearing stablecoin called USD3, and a stablecoin that has a fintech partner share, where the underlying yield goes to different fintechs that use the stablecoin. Most notably right now, it's used throughout Latin America on an app called Ugly Cash, where people can spend the stablecoin with a debit card, or send it to their family and friends around the world. And yeah.
Perfect. And last but not least, I'm Maya. I previously built a non-custodial peer-to-peer on and off-ramping protocol, scaled it in Nigeria and Kenya to multi-millions in liquidity. So let's get started. Let's start by talking about the currency layer. I really think we're going through an Oprah Winfrey effect, where everyone gets a stable coin, everyone's building a stable coin, everyone's issuing a stable coin, and everyone's doing crypto payments, right? So how do we think about distribution to really differentiate ourselves, especially when we're targeting a few different types of customers, consumers and businesses, institutions, and then the crypto native players? Anyone want to jump in?
Sure, I'll talk. I think you're seeing a lot of new stablecoins enter the space, right? And you have the traditional big stablecoins. So that's Circle and Tether's USDC and USDT. They're big. They don't need to share yields. They can really just do whatever they want. Then you're seeing a lot of entrants coming in that are sharing yield somehow. They're not super diversified, in my opinion. It's great to have that, especially for the crypto in crowds that loves to get yield. But it's typically issued offshore and has a tough time gaining traction outside of the crypto bubble. And it's definitely not helpful for the Web3 evolution of payments, I would say. I think what you do need instead of stablecoin yields is probably a great, at least in our experience, a great issuing jurisdiction, better licenses, some unique value proposition, and then really what it all comes down to is distribution, distribution, distribution. And I think you need sort of the mix of the former three in order to land deals to get that distribution. And we are interesting because we do something completely different than most, but I think there's probably very other models out there as well that cater towards true Web3 payments evolution.
I mean, I think there's a lot of innovation right now in the stable coin market, and I think we haven't broken through the dam yet, if you will, right? There's always there's always regulatory hurdles, everybody's concerned, but if you look at some of the emerging markets, you're seeing vast adoption of crypto. You see very high penetration in stablecoins, right? Why? Because they are suffering from very high inflation. Look at countries like Argentina, Nigeria, Turkey. They're all suffering from 40 to 100+% month on month, 40% inflation. And then ultimately, on an annual basis, a couple of 100% inflation. So what currency do they use, right? So that's why they have high penetration. They don't trust their governments anymore. The mistrust in governments and institutions has been growing in the last 4 or 5 years significantly. Where do I go? How many fiat currencies do we have today on the planet? We have hundreds of different fiat currencies, so why can't we have hundreds of different stablecoins? We just need to make sure that they interoperate and people don't give a shit about the actually underlying technology, but you have an amazing user experience.
Before anyone else jumps in, I'm going to push us a bit as well, in the sense that given that there's so many stable coins coming out, why should I as a consumer, or I as a business, or I as an institution choose this stable coin over another? How, as stable coin issuers, platforms pushing stable coins, can we actually think about pushing ours versus the big players or the new players?
This is potentially a little bit controversial, but I actually don't think that consumers care that much. They care that it is worth $1. And that it works when they want it to work, and that it's integrated with the apps that they want it to be integrated with. There's like this is like the opposite of talking my own book. In my mind, there's a very much like a base layer of safety, and any stablecoin that's above that, people don't care about which one it is. They care that the money is there and that it's not going away and that they don't have to scroll Twitter to know whether or not that money's still there. And I think after that, it's like really about what is the user experience for that money.
So do you think a consumer would care if you offer yield on a stablecoin? Is that enough of a point of differentiation?
That is totally a point of differentiation.
Yeah, so let me give it a different spin, because I think that it's very evident that in emerging markets, stablecoin have a huge value, like you mentioned inflation. I was born and raised in the Netherlands, live there still. And I think that, what would it take for, let's say, that region to adopt like a stablecoin? The fact of the matter is that they don't have a need for it, because they think that the government is stable, that the currency is stable. So, when maybe like some of my friends are looking for maybe new yield opportunities, they might look at it. I've spent 10 years in TradFi, so every now and then, someone will reach out and say, hey, what new unique opportunities are there? So they'll look at it as a maybe yield-bearing stablecoin may be thought of as an opportunity, but the fact of the matter is that if you look at stable countries, when there's a geopolitical shift going on, i.e., you saw it with countries like Russia and China maybe getting banned from SWIFT or something like that, that will create a huge push, right? And then and so for the quote-unquote West, even though it's very fascinating to see stablecoin growth in the States, in Europe, for instance, I would say that it hasn't really been, and don't catch me on the stats, but in my direct environment, it hasn't been growing that fast because there's no need for it. At least that's what a lot of people feel now. With Mika coming in and a bunch of other regulatory stuff, I know there's like not Circle, but the Circle Bank is now looking at the Euro stablecoins because they don't want to like stay behind. But I know for a fact, I used to be TradFi, the ECB, the European Central Bank, had a plan to launch a Euro stablecoin by 2021. So yeah, exactly. so Europe tends to be a follower. America is a leader in some way, and then I think that for these regions, stablecoin adoption will come when they're like as a major shift, either economically or geopolitically.
So I know each of you, to some different extent, have been engaging with institutions. What would it take for an institution to actually adopt stablecoins, especially beyond payments? And what would it take for them to shift from really the bigger player in this space? I'm going to name them Circle, right? Why Circle is at the moment the one that the institutions trust the most. So how can you push them to say, actually, there's this other stablecoins and you should consider them?
So institutions are already moving. BlackRock has I believe, their own stablecoin SBIDL. I don't know why they named it BIDL, but they're looking at PSM models. And you see actually institutions moving behind the scenes. They're not very vocal about it. So I do think institutions like big money is already moving. And I think that what's it going to take, like I'm more interested in what you mentioned is like integrations, like for user consuming integrations, because when it comes to the payment layer, people sometimes forget how much it costs to run a credit card and how much you pay for a credit card. And now combinable yield opportunities, for something we're doing at Scroll with ETFI Cash. Now, what's a useful thing to a user is saying, hey, what if you had a credit card, but you're not paying any fees? And as a matter of fact, or a debit card. And as a matter of fact, money that's there on chain, yeah, you don't even, and it's generating yield. And now I think that the reason why I'm so bullish on payments is because like an end-to-end flow, right? We're used to on-ramping, generating value on chain, but now you have like an end-to-end flow and like it has a way out. And so, just to like side rule and not rant, but debanking the bank, banking the debanked people, unbanked people, and then for the consumers in the West, so to say, showcasing like, hey, what if you had a debit card, but you don't pay any fees? So you really talk from a consumer point of view, I think that's going to move institutions into space even more.
Maybe to add to that, I also see institutions definitely moving towards stablecoins already. And one thing I'm super excited about is stablecoins moving up the TradFi stack, basically crypto eating the TradFi world. So you're increasingly seeing, for instance, TransferWise-like businesses that do remittances for consumers between, for instance, the US and Argentina or US and Turkey. They're increasingly moving towards stablecoin rails to basically have a more affordable service. And I think we're going to see more and more of that. Like Stripe is going to replace their entire stack one by one with stablecoin powered services. And maybe you'll actually end up in a world in which we have banks in every country that move their money using stablecoins. Like that is what I would expect to happen.
Just to add a little bit to that, it's highly dependent on like what type of institution are we talking about? Right? Are we talking about a financial institution that is looking to get some kind of yield on their money? Are we talking about a payments company, right? Like Stripe or something else? I think one of the most interesting things about payments companies and stablecoins is, in general, they don't really care what kind of like payment method their customers use. It's really what kind of ways do their customers want to pay. And so it's very much like a customer-driven integration on the payment side that I think is going to like really drive stablecoin adoption on that end. And to someone's earlier point, I forget who said it, but like yield is probably going to drive stablecoin adoption, and then stablecoin adoption will actually drive the payment as a being a stablecoin. And so like I think on that side of the institutions, it's really going to be yield that drives this flywheel of stablecoin usage around the world. And then on the other side, you know, I don't know exactly what it is, but the number one thing that does need to be clarified is regulations. Can banks hold stablecoins on their balance sheet? Or can they not? Can they actually interact with DeFi? Are they allowed to do that? Those are things that hopefully we're going to see some clarity on in the next year or two.
So I'm going to be a bit more controversial, right? I think institutions don't care about Bitcoin at all. And they don't care about blockchain. And they're not going to invest in this. It's up to us to change the industry. Why? At the moment, they have IT budgets. They have committees. They have business units. They have product units. They have to decide how we allocate our IT budget. Is it going to go to crypto, cybersecurity? Is it going to go to AI? Is it going to go to blockchain? And is it going to maintain all my teams and train them and educate them and keep business as usual, other SaaS projects? So crypto and blockchain is going to become a smaller and smaller portion, both at the banking side as well as at the traditional businesses side. So it's not going to come from the West. Maybe from the East it'll come, right? Where they have to compete. They can't trust their money. They don't have the payment rails out there. And the payment rails work in the West, right? We pay 5-7% on credit card payments. So do I really care? It works. You know, people are happy with it. They can go to a bar. They pay much more. And by the way, that dollar, we built stable coins. Why? So that we could transfer money amongst us crypto knights. Right? Not so we could change, and we wouldn't need to go to the banks and worry about on-ramps, off-ramps, transfer, move it across to another exchange. No, we built stablecoins to manage the flow of money between exchanges so that we could move it from crypto exchange to crypto exchange. And now, all of a sudden in our mind, we've come to the realization that actually the dollar in crypto, on crypto rails, to your point, stays a dollar. Whereas in credit card world, that dollar doesn't stay a dollar. The gas fees are way higher. They're 3, 4, 5%. Actually, no, 5 to 7%. Depending if you're an online merchant, you pay up to 15% gas fees on a transaction. And so you don't have that on the blockchain rails. And I think that's why we are today, and we are so excited about payments. How do we drive velocity of money in crypto land using these new payment stack?
So maybe a question for you, Stephen. Are you in favor of institutions in the West or against? Because you said you were against, and now
I'm not against.
It's 5 to 7%. That's a lot of money.
Yeah.
And the West loves 5 to 7%. I'm pretty sure.
Yeah, but imagine how they pay that, right? So you have an issuing provider. How many middlemen? There's 7 people across that. So every 7 person get 1% each, let's say on average, right? So there's so many middlemen, and in crypto, we've taken out of that middleman, and now we want to put them back in again.
No, I think you can re-architect the stack and make it much cheaper.
Exactly, yeah.
That's why you see SAP and Ernst & Young showing up to Stable Summit all of a sudden.
Yeah.
That's not a coincidence. That's institutions driving money into the industry to ensure that they can do payments at 1%.
No
Yeah,
offense to Ernst & Young and SAP, you're welcome.
Please give me money too.
Just to build on that a little bit, my last company did a tiny fraction of lending volume that MakerDAO does. It had 500 engineers, and MakerDAO had like 10 or 20 when it got built in the beginning. Like, you know, I know you were saying like banks don't like blockchain technology, but banks really like their bottom line. Yeah. And 500 engineers is a lot more expensive than 20. And so like I think that the automation that comes from blockchain, I actually don't love using that term, but the automation that comes from blockchain is massive in the financial world. Like the operations portion of a bank is huge, and that is like what the stablecoin fixes. And actually, another thing that you were saying earlier, Stefan, I'm just going to continue to disagree with you on this one. You know, you were saying that like money works pretty well and like payments work pretty well. They do. And like I don't, the banks do work. I have a credit card, yeah. But have you tried sending a wire recently? It is awful. And I know that's like kind of a cliche thing for stablecoins, but like the settlement thing does matter, and the immediate settlement that comes from stablecoins really does make payments a lot easier. ACHs have a 64 different like return codes that you can get, and they go up to like 48 days. Like that's like a crazy thing. Like, have you ever tried integrating with ACH? It is so annoying. it's stablecoins really do like address those things.
And I guess just to add one point before I pivot the conversation slightly, I think the interesting thing is I remember being at UBS and learning about crypto back in 2016. They were investing heavily in smart contract development. You see the fact, and you're right, I think it will come from an institutional perspective. I think Asia is going to push the way forward, especially the likes of Singapore. They've been very welcoming to Western banks joining sandboxes, and you're seeing the Swiss banks, European banks going over to Singapore to test new iterations, implementing blockchain technology, crypto technology, whatever you want to call it, really, into their processes. But you're also right in that it will be an abstraction of the technology. It's unlikely to be the way in which us crypto purists see it. And that's something we may have to reconcile with as a space. So to pivot slightly, we started to move into infrastructure, right? Beyond simply having beyond the high level of having a higher throughput and access to RWA data, what do stablecoins need from the transaction and the infra layer that is currently missing? And how do we go about improving these spaces? Because they're typically overlooked.
So I think per your point, like when you said institutions, right? Right now we actually have different ecosystems. So each ecosystem would have, let's say, I think their shortcoming. I think that in the Ethereum ecosystem, like finality and like, so I'm a huge, obviously like, okay, probably a little bit shilling because obviously Scroll is powered by ZK. So I think that economic security through validity proofs is what needs to be empowered more, as opposed to making trust assumptions and having like social guarantees. So I'm part of the Ethereum ecosystem, which is, I think that it's just like a bubble, right? And then there's just like, I was just talking to my colleague Alex here, who's in front, and he was telling me all the amazing things that are happening in the Move ecosystem. And then you have the Solana ecosystem. So I think that each of these ecosystems have their own shortcomings. And I think in our ecosystem, I think that arguably, like, you can have debates about it, but I think finality is a huge differentiator. But how finality is as well, like reorgs and rollbacks, you don't want those things. You can't afford these things for payment and for settlement. And so I think that economic security through validity proofs needs to be enforced harder, and needs that's what I'm banking on, and I would say it needs. Yeah, it's missing is like we're doing it, but it needs to be done more.
Wait, you're a bit above my head. Can you say that one more time? Like it needs to have stronger. It needs to have better settlement than Ethereum. Does any blockchain have better settlement than Ethereum, like faster and more final?
No, I should clarify that's like on L2s. So right now, today, if you look at Ethereum space, right? Yes, that's correct. Ethereum very decentralized, secure, but Ethereum can't scale. And the scaling solutions today, let's say, the most common ones are OP and ZK. And so the promise of ZK is infinite scaling, but through validity proofs upfront. And so the guarantee of that is that if you send me one stablecoin, a few minutes, hopefully a few seconds later, you don't have to worry about something happening and rolling back. And then suddenly, you're seeing +1 in your wallet, and I'm like, where's my money? I did my service and you paid me. And so we can make trust assumptions, we can build trust assumptions where it's like, trust me, bro, or like another like, or we can trust mathematical proofs, which is, the heart of ZK. And so when you send me something, there's a validity proof. And so you have economic security through proofs, as opposed to trust assumptions. So there's finality on different layers. Yeah.
I think what you were saying was interesting, and I think what we need to highlight as an industry much more is fast finality, right? If you do a wire transfer, it takes you 48 hours to get on the other side. You pay it, and sometimes a phone call afterwards, right? And then they're going to ask you hundreds of questions if it's a big amount, if it's more than $100. So all of that, right? So that's a big downside. I think we also have to address the fact that we deal with multiple ecosystems, right? As you were saying, we got the Cello. Does that work with Move? Does that work with, does that work with Rust? All of a sudden, how do we move money seamlessly so that the end user doesn't need to worry about the losing coins because it's on the wrong chain, or you have an abstracted wallet address that's different from, et cetera, et cetera. So I think those are big issues that we need to address.
Maybe something completely different, but what I believe is core infrastructure that the industry is sorely lacking is some form of credit. Like in TradFi, we have credit cards. In stablecoins or in crypto in general, we have nothing like that. Like we need some form of a credit underwriting system that doesn't require crypto collateral to be posted in order for people to access liquidity, basically. I don't have the answers either, unfortunately, but we do need that.
Just quickly, I like that. I think that's a really important point. But do you think that's due to regulatory issues, or do you think, because technology-wise, it should be possible, right?
I think it's mostly people not wanting to do the work to underwrite people. Off-chain, probably.
We have some amazing risk mitigators in the audience.
And it's a lot of work, right?
Yeah.
It's not fun work. So I get why we don't jump on it, but it's a huge unlock for the industry.
So there's a pretty good system that people use to underwrite spending around the world. It is the credit card system. And what stablecoins are really good at is settlement. And one of the things that I actually that we've been seeing happening, and I actually think is the majority of like real world use case crypto transactions, is debit cards that use stablecoins as settlement. The other one, the next like obvious step there is just credit cards that are paid off with stablecoins at the end of the month. Yeah, and I know that this is like stablecoins as a payments thing, but like everyone in here is probably using a credit card all week. Why would we not go to stablecoins?
I agree, but every single one of those credit cards is pre-funded. Even the ones that are under the hood credit cards, right now. So the next step is underwritten individuals in order to access credit and then paying it off later.
I also think that I've been actually thinking about this lately a lot. I've been talking to some of my friends about it, I like your point. But I also think that no one's willing to bear the risk, right? I think on a protocol level, I think that where it comes down to is like credit score. Credit score is a big issue to fix. There are ways. There's actually so we use ZK for scaling, but there's actually ZK that can be, used outside of ZK. The practical application of ZK actually started in 2014 outside of crypto. It's a whole different space, and you can actually use ZK to utilize credit scores and do calculations. You have TLS Notary that has a mechanism for that. So I would agree with what you said, is that the technology is there, but something out of personal experience I can tell is that unfortunately not all the tech pieces are super mature, I would say. The dev experience is absolutely horrible. And I would say tying everything together and bearing the risk on multiple levels, not just on product, but also like on a technical level, the exposures that you have. I think that there's like still seriously a lot more work to be done. And I know this is an unpopular opinion, but I would love for a hybrid version where there was some guarantees maybe taken off, like Coinbase does, like Coinbase One Insurance. You're insured for up to 1 million even if you lose your private keys. I mean, I'm more on the practical side of things.
Would you not say, though, that one of the problems with having a mature debt market, right, is where you source the capital, right, or the liquidity, right, to finance that? And at the moment, it's very much an LP structure, and there's a high expectation for high yields and interest attached to that. And maybe part of it is that we need to change the way in which we're sourcing liquidity. Maybe it's that we go to DAO treasuries, right? A radical idea, because maybe they're more patient. They may expect lower interest. But with the current structure, I also would challenge the panel in saying that, are we missing a trick by focusing again on trying to optimize mature markets when in fact there are many underserved and immature credit markets that exist, and it doesn't become a technical problem, it becomes an underwriting problem, because the underwriting problem is that we're trying to underwrite in a Western native way when the institutions do not exist in the markets that are underserved to do so.
So credit cards, you ring up a balance, at the end of the month it gets paid off, right? That could be done with stablecoins. The big issue is the underwriting process, like you guys are saying. Maybe I'm missing it, but like, why can't that just be reused?
I think it can. It just hasn't happened yet. So people in the room, please do so. I know of one crypto organization that actually does underwriting. It's ARF. They power remittances for TransferWise-like businesses, and they actually underwrite the businesses that they work with and then provide them credit in the form of stablecoins. That model can definitely be applied to on-chain banks, I think, and then we could all have a true crypto-powered credit experience.
But
who doesn't want that?
But would you not say that even that example is targeting underserved credit markets rather than mature credit markets? And I guess even with the credit card example, of course, there's ways in which we can improve the credit experience in the West, but do we actually need it? Is it enough for the institutions that are powering and issuing the credit cards to be like, actually, let's revamp our system to enable crypto? Or is it that we need to validate the model, a bit like how stablecoins were validated before the institutions started to pick it up, and we validate it in an immature, underdeveloped market, and it doesn't become about crypto. Crypto is just the means. Crypto is a source of liquidity, and then we can bring more on-chain. Food for thought.
I think that, and maybe I'm misunderstanding, so I'm not, I guess, I'm noticing a limitation in my own knowledge. But if I look at, let's say, I'm looking at it from a protocol point of view that right now is either like launching a stablecoin or is like, let's say, 100% on-chain, it's more like DeFi focused. Because I guess, I didn't realize what you said, I guess it's true, but that's done an institution moving, right? An institution switching from USD to USDC. But the way I look at it is that what would it look like for a crypto native DeFi protocol to switch to a credit card model? And that's a very long way. And so, yes, I mean, that's I guess a short of that. But then it's okay, how do you get them to move to adopt stablecoins? Now, another maybe unpopular opinion or hot take is that I'm not sure if we need that, because I see I'm gonna go on a tangent now. I see a door to a fractionalized banking. I see the path towards what led us down to a road where I don't want to go. And so you're saying who wouldn't want credit card banking? Man, but that's a very personal, now it's my personal opinion, right? Nah, fuck no, stay the fuck away. Don't want that here. I love over collateralized or at
what
least
about
collateralized
the airline miles?
Okay, you got me. No, but honestly, I think that we do a lot of things right, and maybe I'm being an ethical maxi right now, right? But I hate, I genuinely, so I'm TradFi, I've been an accountant, I've been in that world, and honestly, I'm not even allowed to talk because I started my career in the debt crisis, and so I was only up from there. And in 2009, I got my first job, and was only up from there. But, what I saw at the heart of the problem is, greed, which is a problem in crypto too, but fractionalized banking was
So banks don't even need to have fraction anymore.
Yeah, that's
so that they don't even have any.
Yeah, now in America, buddy, not this side of the world. So for me, I'm good with credit card actually not being here. I'm good for WL. Although I am excited about novel solutions that utilize yield to extend it a little bit, and all that stuff, or prepayments and stuff like that, to have yield work for you. To throw another buzzword, AI agents. Yeah, I think there are a couple of cool things going on in there.
So one final point, I'm going to ask another question. I guess just another point of food for thought is that even when in the conversation about credit cards, I feel as though sometimes we're thinking of crypto as the end rather than the means. And in fact, what we should be looking for, and this is why I keep pushing underdeveloped credit markets, is where is there a need for credit? Where is there a need for improvement? That is a significant delta, not just an optimization, because we're still, when it comes to credit, and this is a fundamental part in building a competitive digital payment stack, we are still at pre-validation stage. And are we not trying to push beyond that? I know you want to, I feel like you're first. Go ahead.
So I do agree quite a bit that one of the things that people want with payments in general from a consumer perspective is the ability to borrow money before they actually need to pay it off. The other big thing though is they want to get additional money, right? I was joking about airline miles. That has been a massive Ponzi scheme that has worked out really well for Visa and MasterCard. But at the end of the day, the way that it did work is it got consumers to be excited about paying with a certain thing because they got a reward for it, right? And I think we were talking about it in the beginning, and I think it really does come down to how can we take the underlying yield that is generated by the assets behind the stablecoins and use them to incentivize usage. And just to kind of like wrap this all the way around, whether it's the underlying yield being like altruistically used by the Glow dollar, or it's being used to incentivize a fintech app to actually use that as their stablecoin, right? Like eventually it's going to get back to the end user somehow, whether it's like a savings account or something like that. And I think like at the end of the day, like the more solutions and products that can lean into getting the yield to consumers at the end is what's going to drive the payment adoption with stablecoins.
So, we're coming close to the end of time, unfortunately, but, well, not the end of time, that's a bit dramatic, the end of this panel session. But there's one question I did want to round off with. We're sitting in Thailand, we're in Asia, DevCon is happening in an emerging market or a region of the world which has typically been overlooked by crypto. I think one of my key beliefs is I almost thank Gary in many ways, which I know is very controversial in crypto spaces, because it's forced many Western crypto protocols companies to actually push beyond the default belief that crypto is global by default, because it wasn't. And so one of my key questions for everyone on the panel is, as we're thinking about a competitive digital payments stack, how can we really think about ensuring that it is an inclusive payment stack and that we are localized into different market needs? What does that look like for each of you?
I think that for me, it would be, again, lately I've been diving and talking a lot to my friends about the payments, like the vertical stack. I think that, what does that look like for localized needs, you said, right? I think what would be really, really dope is that if we get local networks as opposed to using, let's say, Visa and MasterCard, like a lot of these, like credit or debit card are like white label solutions on top of like these networks. And so empowering, like say, utilizing a blockchain technology to empowering local networks where value is like not just created and generated local, but like distributed local as well. I think like it's much easier to generate yield that way as well and like redistribute it. So that's something that I think that is lacking, and then I'd be excited to see.
I don't think local in crypto matters, right? We go cross jurisdictions. We're all from all over the world. How do we service people that are constantly moving from country to country, that live 2 years in this country, move to another country, maybe don't live in a permanent housing. They have a serviced apartment that is not even theirs. They just pay rent. They live from Airbnb to Airbnb. How do we service that community? That community already today is about 40 million strong, $800 billion in spending. How do we provide them with products, insurance products, credit rating, other assets so that they can save their money, it doesn't get depreciated by interest, by inflation, et cetera, et cetera. So that to me, so local jurisdictions don't really matter. How do we transcend jurisdictions? Because I can tell you, a local government has no idea about how it works in other countries, and they have no jurisdiction in any other countries. And so that's a big problem that the internet and crypto addresses, but the fiat world doesn't address it.
You guys are talking about totally different user groups, but I actually do think stablecoins are a great use for both of them. And it really does come down to the reasoning that, like, at the end of the day, what do people want? They want to be able to not lose the value of their money. They want to be able to spend it very cheaply. And hopefully they want to be able to exchange it for whatever goods or other money they need, right? That's cross-border payments to other currencies. Like, these are the things that, like, crypto is so perfect for. And it doesn't matter the size of the transaction, except for fees, and it doesn't matter the jurisdiction or anything like that. Like, that's the beauty of stablecoins, is that it can go to any jurisdiction, and it does solve like the very distinct use cases that are totally different that you two are talking about.
For us,
Well said.
it's probably a stablecoin in every country that's localized, plus moving from 1 to 5% on-ramp costs to 0, or perhaps even negative on-ramp costs if you take the yield and you incentivize the institutions. Yeah, I think those are the two most powerful things.
Perfect. Well, we could talk for hours, it seems, for sure. But we have, the red sign is telling me time is up. So thank you so much for joining this panel. Hopefully you've enjoyed it as much as we have.